US-based firm Viceroy Research has taken a short position against the debt of Vedanta Resources, the UK-based parent of Indian mining company Vedanta Limited. It has alleged that the UK-headquartered firm is systematically draining its Indian unit. This charge has been dismissed by the group as a malicious combination of misinformation and baseless allegations. The remarks come after an 87-page report was released by the American short seller on July 9. So, what is this report and how has the Viceroy Vedanta saga unfolded? What does it mean when we say that Viceroy has taken a short position? In this video, we'll talk about what Viceroy is saying, how Vedanta is responding, and where the Indian government fits into all of this. But before we proceed, I'm happy to tell you that starting this week, ThePrint will often bring you explainers and analysis that unpack important issues of corporate governance, which also find their ripples in political economy and across institutions. And we begin with the Vedanta Viceroy episode. Vedanta Limited is a large Indian multinational that deals in natural resources like metals, mining, oil, and gas. Anil Agarwal, the founder and chairman of this company, is known for building the group through bold acquisitions and aggressive expansion over the years. Viceroy, on the other hand, calls itself an investigative financial research group registered in the US. They're basically a short seller, someone who bets on a company's stock falling and then makes money if it actually does. While many traders try to profit from rising stocks, short sellers do just the opposite. They profit from stocks that decline in value. Traders sell shares that they do not own but are instead borrowed from a broker. If the price of the stock drops, the short seller buys the stock at lower price and makes a profit. Let me illustrate this with a very basic example. Let's say that a stock is trading at 100 rupees a share. You borrow 100 shares from a brokerage and sell them for 10,000 rupees. For one reason or another, the price of the share then drops to 50 rupees. At this point, you purchase 100 shares to replace the ones that you borrowed at 5,000 rupees and pocket the remaining 5,000 rupees as profit. Most institutional short sellers like hedge funds merely trade on the basis of signals and their analysis. However, activist short sellers like Hindenburg, Muddy Waters, and Viceroy rely on exposing hidden financial risks in a firm and alleged fraud to drive the stocks down. They often look at corporate filings, financial statements, and possible misreporting to make their bets pay off. And yes, it's perfectly legal to do this, so long as the reports and investigations they publish are factually accurate. And if the report is evidently false or manipulative or there's insider trading, regulators like SEBI in India, SEC in the US, and FCA in the UK step in. In the case of Hindenburg's Adani report, the SEBI issued a show cause notice to the short seller to present its side of the facts. Hindenburg said they were aware that the Indian securities regulator was grappling with how they were going to respond to them, since it was a US-based research firm with no presence in India. There are risks and ethical debates over this too. On paper, the risk is uncapped, since the stock you've shorted can just keep rising. Certain investors also sometimes view shorting as betting on failures rather than wagering on success. But for now, let's come back to the Viceroy Vedanta story. On July 9, Viceroy released the 87-page report just before Vedanta's annual general meeting. It said that the core of the investigation rested on a simple principle: that Vedanta Resources was a parasite holding company with no significant operations of its own, and that it was propped up entirely by cash extracted from its dying host, which was Vedanta Limited. For the purpose of this video, whenever I say VRL, it'll refer to Vedanta Resources Limited and its web of intermediate holding companies controlled by the Agarwal family. And when I say VEDL, it'll refer to the publicly listed Vedanta Limited in India and all of its consolidated operating subsidiaries such as Hindustan Zinc, Balco, and Cairn Oil and Gas. To get the cash that it needs, VRL forces VEDL to declare disproportionately large dividends, which are funded not by free cash flow but by taking on more debt. VEDL's dividend policy is dictated entirely by VRL's financing needs, not by its own ability to generate cash. This is one of the core allegations of Viceroy. In the last 3 years, VEDL has paid $5.6 billion more in dividends than it earned in free cash flow. Its net debt has jumped by $6.7 billion since FY 2022, almost doubling in just 3 years. Basically, to service its debt, VRL systematically drains VEDL. Viceroy says this arrangement has pushed the entire group to the brink of insolvency, propped up only by a continuous cycle of new debt. Please remember that when I speak of anything from the perspective of Viceroy, these are all just allegations. None of it has been proven so far. If one distills the 87-page report by Viceroy, it largely hinges on the following alleged discrepancies. 1. Viceroy says that Vedanta Limited promotes ludicrous capital-intensive projects that it can't even afford. It does this just to raise fresh capital, and this capital is then paid out to Vedanta Resources. 2. It says that Vedanta's interest expenses are unusually high and continue to increase even though it's repaying loans and restructuring its debt. Sample this. In FY25, VRL reported a total interest cost of $835 million against a gross debt of $4.9 billion. Now, simple math shows that given these figures, the effective rate of interest would be 15.8%. Viceroy says this is inexplicable because VRL's publicly issued bonds and disclosed term loans carry rates of about 9 to 11%. According to the short seller, there could be three possible explanations for this. A. Undisclosed off-balance sheet debt is being serviced with costs that are being disguised as interest expenses. B. High-cost intra-period loans are being taken and repaid before reporting dates arrive to mask the true level of debt. And C. Loan rates or conditions are being misreported to the market. Moving on to the third allegation, Viceroy says it noticed inflated asset value across VEDL's large list of non-performing subsidiaries. The debt across these assets vastly exceeds their true value and is cross-collateralized among the group of companies. In simple terms, this means that the same asset is used as security for multiple loans. 4. It also says that expenses across these subsidiaries are systematically capitalized, artificially inflating profits and assets value. Now, what does this mean? This means that Vedanta is masking everyday costs as investments. 5. The financial firm alleges that billions of dollars of disputed expenses are kept off the balance sheet and undisclosed in financial reports. 6. Viceroy says that Vedanta shows systematic governance failures across management and auditors, including inappropriate auditor choices. It says that VRL is a financial zombie that is being kept alive only by transfusions of cash from its subsidiary, VEDL. Viceroy says that even one of the things it has outlined is sufficient to topple Vedanta's fragile Ponzi-like structure. It says the Agarwal family quietly built a parallel operating structure outside of VRL Group to carry out questionable activities. And lastly, it says that VRL extracts hundreds of millions of dollars annually from VEDL and its subsidiaries through brand fee without any justification. In FY24 alone, this fee was $338 million. The brand fee is basically the money VEDL pays to its parent company VRL for using the Vedanta name and the brand. Now, Viceroy says that its investigation into Vedanta's key subsidiaries reveals a portfolio riddled with lapses. Let's talk about some of these companies. Fujairah Gold operates a precious metal refinery in the United Arab Emirates. Viceroy says that this Dubai-based subsidiary appears to deal in undocumented or illicit gold. It also says that Talwandi Sabo Power, or TSPL, has a virtually worthless power plant. Its accounts contain about $350 million in hidden liabilities against a $400 million balance sheet and enormous operating cash losses. The Konkola Copper Mines, or KCM, is a Zambian asset that it says is insolvent and operationally unviable. And ESL Steel is another loss-making steel plant. But a company that is most sharply in focus is Hindustan Zinc Limited, VEDL's crown jewel. According to Viceroy, it is a legal and financial minefield. It says Hindustan Zinc's resources are being looted through deals with promoter family-owned companies and unjustifiable brand fee. It alleges that Hindustan Zinc has massive hidden liabilities and that its original 2002 disinvestment to Vedanta is under active criminal investigation by the CBI. In early 2023, Vedanta proposed selling its international zinc assets under THL Zinc to Hindustan Zinc in a phased transaction for $2.9 billion. But the proposal lapsed as the Indian miner did not get shareholders' approval. It is very important to note that the Government of India is the largest minority shareholder with about 30% stake in the board of Hindustan Zinc. The Ministry of Mines had said in a letter then that despite being the largest minority stakeholder in the company, the government was kept in the dark about the deal. In fact, according to some reports, government nominees on the Hindustan Zinc board are expected to question the management on the dealings with promoter Vedanta Limited. Amid all of this, Vedanta says that Bharat Aluminium Company or BALCO is the exception that proves the rule. It says that BALCO stands out as a rare example of disciplined capital management and independence within the Vedanta group. It says this is likely because the Government of India retains a 49% stake and a board oversight in the company. In a nutshell, these are largely the allegations by Viceroy against Vedanta. Vedanta shares crashed as much as 8% on the day the report was made public and settled at about 3% lower. The report also impacted the shares of Hindustan Zinc, which declined almost 5%. And this is not the first time Viceroy has made headlines. In the past, they have exposed problems at companies like Steinhoff and Wirecard, both of which blew up spectacularly. Now, Vedanta released a statement soon after Viceroy's report went public. It said that the report was a malicious combination of selective misinformation and baseless allegations to discredit the group. Here are some bits from the statement, which came a day before Vedanta's AGM on July 10. The report has been issued without making any attempt to contact us with the sole objective of creating false propaganda. It only contains compilation of various information which is already in the public domain, but the authors have tried to sensationalize the context to profiteer from market reaction. The timing of the report is suspect and could be to undermine the forthcoming corporate initiatives. Our stakeholders are discerning enough to understand such tactics. In fact, to avoid any responsibility, the authors of the report have added various disclaimers that the report has been prepared for educational purposes only and expresses their opinions and are not statements of fact. But you'd think that after a report like this, Vedanta would hit back hard at its annual general meeting, right? That didn't really happen. At the AGM, which was held on July 10, Vedanta's top bosses, including Chairman Anil Agarwal, barely acknowledged the report. Viceroy called the AGM scripted and a charade, saying that the company just ignored serious allegations in front of its shareholders. It put out a follow-up memo calling Vedanta a house of cards, accusing the company of treating the AGM like a formality and ducking questions. Global brokerage house JP Morgan, however, said that while questions have been raised around the structure and practices of Vedanta and its subsidiaries, its own analysis points to sound metrics and robust government oversight. It said that it continued to remain comfortable with the company's financial profile and won't get distracted by third-party concerns such as this one. Proxy advisory firm InGovern has also raised concerns over foreign research outfits not registered with SEBI publishing reports on Indian companies. It said that such outfits are not subject to Indian regulatory scrutiny even when their actions directly impact Indian investors and markets. It said that both the Viceroy report and previously the Hindenburg report highlight how activist short seller inputs can trigger significant market volatility and force a re-examination of corporate governance and financial practices at large Indian conglomerates. InGovern pointed out that holding company structures, which is a key point of criticism in Viceroy's report, are common and legitimate in capital-intensive sectors like infrastructure, mining, and energy. Vedanta has been planning to split into multiple separate entities and said in 2024 that it aimed to cut its debt pile by $3 billion in 3 years. Group Chairman Anil Agarwal launched a plan a year earlier to overhaul the business after an unsuccessful attempt to take Vedanta private in 2020. Vedanta's UK-based parent has in the past battled a host of rating downgrades, triggered by worries over outstanding dues. Since its full report on July 9, Viceroy has been releasing small notes, repeating and renewing its allegations against Vedanta. It has also said that it is waiting for SEBI to respond to the queries over the Vedanta issue. Now, if SEBI and Ministry of Corporate Affairs choose to step into the issue, this could become a large regulatory flashpoint. A lot of people have also been drawing parallels between the Viceroy report and the Hindenburg report on the Adani Group. Well, there are similarities and then there are differences. Both reports argued that the companies presented a healthier picture than what was the reality. The difference is that while in the case of Adani, the allegations focused heavily on offshore shell companies and stock price manipulation, in Vedanta's case, the focus is on financial structuring and consolidation. It's more an accounting governance issue.